Hello friends, welcome to my YouTube channel at Kamal. As you go through this video, please do subscribe to my channel and also press the bell icon so that you can get regular updates on new videos as they are uploaded on my platform. The last week was a mixed one for the markets, with the Dow Jones Industrial Index going down by about minus 0.1%, S&P 500 up by 0.36%, but Nasdaq really rallied and was up 2.15% for the week, as you can see on this chart. In fact, Nasdaq has been rallying continuously since the mid of June, as you can see at the bottom of this chart. And this has been driven by a decline in 10-year yields and stronger than expected earnings from some of the Nasdaq majors. As you see on this chart, you can now see that Nasdaq is now above the 100-day moving average and actually testing resistance at about 15,500. Which was kind of the low of the Feb-March pullback earlier this year. So interesting place where Nasdaq is positioned currently. Crypto markets were also mixed, with Bitcoin down 2% for the week. MATIC was flat. ETH was up 1.3% and AVAX rallied up by almost 6%. Solana was down 7.4%, driven by a pretty, uncommon event where there was a hack of their Slope mobile wallet, where seed phrases of about 8,000 users were compromised and about $4.5 million worth of Solana was lost. This is quite strange because Phantom Wallet is a self-custody wallet, and it's unclear why users could be convinced to move their seed phrases from Phantom Wallet to Slope mobile wallet, and then it could be compromised over there. So at least I have not been able to understand what really happened, and it's kind of a very weird happening. All sympathies for people who lost whose seed phrases got compromised and who lost their balances, their Solana balances. The most interesting news of the week was a very strong jobs report that came out. The July jobs report showed that non-farm payrolls increased by 528,000 compared to the 250,000 estimate that briefing.com had for the July results. And this was in the back of an upward revision in June. So very strong jobs report. And it was true even for private sector payrolls, which increased by 471,000 compared to an estimate of 200,000. And again, on the back of upward revision in the June numbers. As you can see on this chart, the unemployment rate has come down. It has been coming down and has been very low. It's now as low as 3.5%. And in fact, the jobs picture is now back to pre-pandemic levels. In fact, very similar to Feb 2020, when also the unemployment rate was 3.5%. And actually the total employment numbers were 152.5 million compared to 152.54 million that we saw in July. Now, what happened in response to this? In response to this, the CME FedWatch tool showed that the odds for a 75 basis points hike in the Fed funds rate in the September meeting doubled from 34% to 68%. So the narrative that the Fed would be able to be less hawkish as inflation rolls over seems to be weakening. Also, the 10-year yield went up by 15 basis points on Friday, to be at about 2.82% by end of day Friday. Now, while this was happening, the markets didn't come down dramatically. In fact, they held up, and this implies that somewhere the market still believes that the Fed will not be able to sustain on a very hawkish monetary policy path for long and will have to change course. The other important thing I want to talk about is earnings. With nearly 80% of S&P 500 companies having reported their Q2 earnings, the results show that about 75% have beat on earnings and 5% have met expectations. In addition, about 71% have beat on sales. Now, these numbers are consistent with historical beats, where on an average about 80% of the companies either beat expectations or meet them every quarter. But there is one big difference. This time, the beat has been on lowered expectations. And this is evident in the fact that post earnings, the Q2 estimate for S&P 500 EPS has come down by 4.22%, as you can see on this chart, compared to the expectation just before the earnings season began on 30th June 2022. The number was 55.01 on 30th June, and is now 52.69, so a decline of $2.3 in EPS for the entire S&P 500. That is quite significant. The decline is also there in the estimates for Q3 EPS, which is down minus 4.54%, and Q4 estimates, which is down minus 3.61%, leading to an overall EPS decline estimated for 2022 full year by minus 3.2%. Now, as a result of this decline in EPS, combined with the recent market rally that has happened, the price to earnings expectations for 2022 full year has jumped to 19.14 compared to 16.89 on June 30th. And at 19.14, it is worth thinking seriously on whether the market is really undervalued. Finally, last week I had been talking about whether the coast is all clear or not, and I felt it wasn't. This week, Briefing.com in its big picture has also laid out all the headwinds that exist, which make it unclear on whether all the headwinds have gone away and whether the coast is fully clear and there is no major uncertainty along the way. See this chart where Briefing.com lists out all the key challenges that the market is facing at this point in time, notably that the yield curve is inverted, especially the 10-year minus 2-year, which is negative close to 35 basis points. Fed officials continue to be hawkish in their statements and are talking about moving to a neutral Fed funds rate. Initial jobless claims seem to be increasing. They came at 260,000 this week, and that is one of the highest numbers seen in recent times. Also, we all know that many large companies are talking about slowing hiring or cutting jobs. So job market is looking a bit dicey. On the consumer side, the real disposable income has come down. I talked about it last week, and driven by higher inflation. So in spite of wage growth, real disposable income has come down, and consumer confidence is at one of its lowest levels in 40 years. So with real disposable income down and consumer confidence low, and the US being a consumer-driven economy, it's not clear on whether tough economic times have gone away completely. Also, the housing market seems to be rolling over, driven by high mortgage rates and increasing housing prices. And finally, the slowdown is global. Europe came out with a negative manufacturing PMI this week. Bank of England governor has warned about a recession that may last 5 quarters. China is slowing down. And a strong US dollar is really a very strong negative headwind for most of global growth. Given all of this, I genuinely think that the market will continue to be choppy. There is still a lot of uncertainty, and people should watch out before going fully aggressive in their portfolio allocations in the market. Thank you.